Hello everyone, thanks for checking out my video. Here are some quick highlights for this episode of Weekly Market Analysis. Apple, Amazon and Google reported poor earnings. Some of the largest tech stocks were down from 2 to 8% on Friday. Fed continued its rate hike campaign with 25 basis points. Jobs report remained strong, exceeding expectation by almost 180%. And yet, the US stock market continued to hold up with S&P 500 and Nasdaq clocking another weekly gain. What's going on with the market? Are we really in for a new bull run? What are the investment strategies for both bulls and bears? Stay tuned to find out more. Most stocks closed lower last Friday as a stronger than expected jobs report worried some investors that the Fed would keep raising interest rate. In case you're not aware, the Labour Department reported a surge in non-farm payrolls with 517,000 jobs, way above the expectation of 185,000. In addition, unemployment rate US remains low at 3.4%. In fact, it is the lowest since 1969. Such a tight and resilient labour market could potentially fuel wage increases, which is a contributing factor to the pace of inflation. Meanwhile, Wall Street also digested earnings results from various mega-cap tech firms, such as Apple, Meta, Google and Amazon. All these four companies reported disappointing numbers. As a result, Amazon fell more than 8% on Friday, Google retraced more than 2.5%, but surprisingly, Apple and Meta rallied, with the latter skyrocketed by more than 20% post-earnings report. Despite all these reports and data, investors continue to see hope from recent signs of falling inflation numbers, as well as positive comments from Jerome Powell as he mentioned that this inflationary process has started. This is probably why the market is still holding up quite well. After clearing some major obstacles, what's ahead of us then? The next key event is the release of January's CPI data on 14 February, Valentine's Day. Further drop in the inflation number will likely fuel the current rally. On the flip side, a surprise to the upside for CPI will probably trigger a big decline in the market due to the mismatched expectation between investors and the actual inflation number. If we were to look beyond these 2 weeks, investors should bear in mind that Fed's monetary policy may continue to have significant negative impact on the economy in coming months as the interest rate remains high. Don't forget monetary policy works with a lag. Lastly, the greed level in the market is quite high at the moment. As a recap, it was 69 last week, and it's currently sitting at 76. Typically, though not always, such high greed level preceded temporary tops and huge declines. But of course, a healthy pullback followed by a new bull run is always possible. At the moment, technical charts are looking bullish, but something interesting has been spotted on SPY chart, which brings me to the next segment, technical analysis. So as usual, we will begin things off with SPY. In my last video, I shared about a bullish cup and handle pattern. And guess what? The pattern turned out quite well, and SPY rallied hard. I also mentioned that if SPY can break above 408 convincingly, it may fly towards the gap at 416 to 417. Guess what? We hit 418 last week. Okay, so what's next? Again, I am going to paint the bull and bear scenarios. And to be upfront a little bit, the probability of a pullback or bear thesis playing out will be higher this week. But then, this does not mean we will have a huge decline. It just means the pullback is highly likely after 10 green candlesticks in the last 11 trading days. Don't ask me the extent of the pullback, or will it happen on Monday or Tuesday or which day, because I don't have a crystal ball. Alright, let's dive in. A bearish shooting star candlestick has appeared on the daily chart. This candlestick usually appears after an extended uptrend and typically signifies price correction is coming. But of course, one candle isn't all that significant given the recent massive rally. Therefore, the candle that forms after this shooting star will give us more indication. Bears would want the next candle's high to not exceed the high of the shooting star, which is around 417. It should also close below the closing price of the shooting star, which in this case is 412. A lower closing price and a red candle on Monday will give a stronger indication that a potential correction is on the card. To add on, the current run-up could potentially be similar to June to August 2022 period, something that I mentioned in my last video under Apple's analysis segment. Interestingly, The last two candlesticks look quite similar to the ones in August 2022. So let's say a pullback comes this week. We do have a few strong supports below the current price. The first level to watch would be 408, which it broke above recently. It will now act as a support. But even if SPY falls below that, I would not be too concerned if I am a bull, because the key support levels are the three levels that I have been talking about: downtrend line, 50 moving average, and the 200 moving average. These price levels are around 391 to 394. Therefore, as long as SPY stays above these levels, bulls should still have control and should not be too concerned. On the other hand, let's say the next candlestick does not confirm the bearish shooting star pattern and SPY continues to rise. We have a resistance at 423. Personally, I think this should pose as a strong resistance level, as that is the first Fibonacci extension level above 100%, and traders will likely take profits, which means sellers may start stepping in to offload their stocks. For a full-blown breakout to happen, we need to break above last year's August high at around 428. When that happens, good luck to the bears. It will be difficult to justify any bear thesis, unless inflation goes up again and Fed turns super hawkish again. Okay, let's have a look at Apple. 11 green candlesticks in the last 12 trading days. It's as bullish or even more bullish than SPY. Apple reported poor earnings results, and yet it rallied on Thursday and Friday, where most tech stocks were down. Can this rally continue? I don't know, but let's check out some of the resistance levels that could potentially stop Apple from flying further. The next resistance level is actually a critical one, which is 156. It is at a Fibonacci retracement level where sellers usually step in to take profits. As you can see, Apple briefly went above it on Friday but got rejected and came back down. This level is also the high that was set in October 2022. But let's say buyers continue to overwhelm sellers. Wow, the next resistance above this is actually some distance away. I would say it's around 170 to 171, where there is a gap waiting to be filled. When we reach that level, buyers may even continue to push it to retest 175, the high of August 2022. And mind you, from 156 to 170, that's 15 points upside, which is massive in Apple's context. On the downside, let's say Apple cannot overcome the 156 resistance, 150 will be the next support, which in my opinion is a weak one. The strong support should come around 147, where the 200 moving average is right now. To highlight, there is also a gap at 146 to 147 waiting to be filled. Below these levels, the downtrend line will also act as a support. Similar to SPY, anything above this trend line, bulls still have the upper hand. To add on, Apple has been hugging the top of the Bollinger Band for some time, and it even pushed above it last Friday. That is a good news for bears, because when such thing happens, a retracement is usually on the card. But once again, nothing is guaranteed. Watch how Apple moves this coming week, alright? Okay, moving on to Tesla, one of the best performing stocks in January this year. Just last week, I shared that if Powell don't give us some bad surprise, Tesla should have the chance to run up to 198 or even 200. And I believe investors or traders may start taking profits at this level. Guess what? We hit 199 on Friday, got rejected, and got pushed down to 190 at closing. At this point, if you have found my video useful, please help me with the like and subscribe buttons so that the video can be pushed out to more audience. Anyway, for this week, 198 to 200 will continue to act as a resistance level. If we close above it for 2 days or so, there is a chance for Tesla to charge towards the Fibonacci extension level of 222 and even retest the 200 moving average at around 229. That's about another 20% upside from the current level. And since we are on this, remember I have been talking about Netflix, Nvidia and Meta rallied 40 to 100% and how Tesla could potentially follow suit. And there you have it, Tesla rallied almost 100% in the last 1 month. So can this monster rally continue? Absolutely. But will I chase? Probably not. Again, it's all about probability. When Tesla rallied 40%, the odds of it rallying another 20% is decent. But now that Tesla has rallied almost 100%, the odds of it rallying another 20% will obviously be lower. right? Not being a bear here, just painting the probability, and you can make your own judgment call. Who knows, maybe Tesla continues its current rally and charge towards 250 or 280? Nobody truly knows what will happen in the short term. In the long term, yeah, I am a Tesla bull and I believe we will climb back to 250 and 280. Anyway, let's say we have a pause in the current rally, watch out for 162 as the next immediate support level. A stronger support would be around 146 to 154, where there is a big gap. This area is also where the 50% Fibonacci retracement level sits, together with the 50 moving average. There are two more gaps below though, in the 120s and 130s range, which will serve as a magnet to pull Tesla down if 146 does not hold. Moving over to Meta jumped massively post-earnings report. I don't know about you, but I am super wary of this huge jump if I am a short-term trader and will look to take profits. Personally, I think that the gap up is way too huge to not to be filled. This kind of more than 15% single-day rally often does not end too well. Not financial advice, but I wouldn't be surprised if people start taking profits or short the stock in the upcoming 1 or 2 weeks and cause the price to drop. So if traders start taking profits, Meta has a support at around 184. When that breaks, we will likely come back down to the gap area between 153 to 180. But whether will it completely fill the gap, it remains to be seen. There is a major support at around 151, which is the 200 moving average. On the upside, if buyers keep stepping in, the next resistance will likely be the psychological level of 200. And if that breaks, we could fly towards 220's range. Now let's have a look at Google's chart. Google was looking bullish before its earnings report. It actually broke above two stubborn resistance levels at 100 and 105. But it came back down below 105 on Friday. So for Google to be bullish, it needs to reclaim 105. And when this happens, it also means that Google will close above the 200 moving average, which is a bullish signal. When that happens, there is a chance for us to head towards the gap at the top between 108 to 109. On the downside, we are just right above this gap between 101 to 102, and I think the chance of us filling this gap is higher than the gap at the top. The 100 level, which previously was a resistance, should act as a support now. If it gets breached, then we will likely chop around the range of sub 90 to 99 again, just like how we did it from October 2022 to recently. Some end thoughts as we entered the second month of 2023. Well, last month has been great for the bulls. It has been a while since I last saw my long-term portfolio being so green. Right now, perhaps the biggest downside about the current market rally is that it's too strong and fierce. I mean, Nasdaq had positive gains for 5 straight weeks, so don't be too surprised to see a market pullback. I know I have been talking about this pullback since the week of Jan, thereabout, and we did have some retracements, small ones here and there, but I feel a slightly bigger one is necessary purely from technical point of view for the bull run to continue. Perhaps Friday's dip was the start of a much needed breather. All said, here's my investment strategy. Personally, I don't like to chase a raging bull, but then again, it is also unwise to go against the trend when it's so bullish now. So what I would consider is to look for pullbacks and then pick up shares along the way, just like how I did it when the market was crashing left and right last year. As usual, I am going to do it prudently and gradually. It's nothing new. For those who have followed me, you would know that has been my style. To clarify, by doing so, it's not so much of me believing that we are at the start of a bull run. It's more of that's just my method of investing. Dipping my toes in whether the market goes up or down. Though if I must say, I'm still not super convinced that the weak market is behind us. But of course, with the market holding up after a busy week of earnings, rate hike, economic reports, my bullish sentiment has increased. That being said, the cautious side of me still remains cautious. What if, just what if, the inflation remains sticky? Or what if it makes a comeback by going up again? Or Fed just keep the interest rate at a high level longer than expected? What if this is another June to August 2022 all over again, where the market shot up and came back down massively? Anyway, for bulls who believe this is the start of a new bull run, I thought the strategy of picking up shares when there are pullbacks in the next few weeks may not be too bad. The reason is simple. The the market does not go up in one straight line, so buy the dips when it is on its way up. I mean, we had lots of green arrows last week or even the last few weeks, but if you notice, there were slight pullbacks along the way. For instance, Tesla pulled back more than 6% on 30th January, while Apple retraced 2% on the same day. Google dropped by 2% for 2 consecutive days on 24th and 25th January. And then you have Amazon sliding more than 8% last Friday. The list goes on, you get the drift. So now as we entered February, there will definitely be pullbacks. It is just a matter of how big the retracement is. Therefore, if you firmly believe that the bear market is all behind us, then these pullbacks could be buying opportunities for the bulls. On the other hand, if you are a believer that we are still in a bear market, then by all means wait for the market to go down again. That said, do have a contingency plan in mind, or be prepared to adjust your plan if necessary. Let me throw out some questions for your consideration. What if the market continues to go up in the next few months? Are you going to wait for another war, another bear market, or another crisis so that the market will crash again for you to enter? While waiting, what are you going to do with your cash if the next crash is more than a year from now? I mean, crash doesn't happen every year, right? Therefore, how about considering setting some price targets? Say for example, if S&P 500 or Nasdaq reach a certain price that is higher than now, accept that the new bull run has started and drop the bear thesis. Or the alternate solution is don't wait till SPY to say fall to 360 or 340. Start dipping in a little bit if it pulls back to low 400 or just below 400, while holding on to some cash to stand by for the big decline that you are waiting for. By doing so, if let's say you are wrong, you still have that say 20 to 30% of cash already pumped into the stock market, and you could still ride the bull trend. Anyway, these are just my perspectives as I try to put myself in the shoes of a bear and a bull. And what would I do if I am them? Definitely not financial advice, but hopefully it can value add to your own research and thesis. So what are you at this stage? A bear or a bull? Let me know in the comments section below. Alright, that's all for this video. As usual, if you found this video useful, please help me with the like and subscribe buttons if you haven't. Thank you.